What's up, everybody? Welcome to another episode of the Stock Bros podcast. My name is Tony, and it's been a crazy week in the stock market. We got AMC and other meme stocks soaring because of a potential short squeeze situation. There's a lot of chaos going on, but overall, the general market indexes have done pretty well. They've been pretty steady. So before we get into short squeezing and what it means to short a stock, please remember to subscribe, leave a like, leave a comment, and also check out my links in the video description below. If you want to get started with investing, I created a course on Udemy, perfect for beginners with no experience, teaching you the ABCs of investing. And also check out my links for Public and Acorns, two great apps to get you started. So let's get into it. Let's talk about what it means to short a stock before we talk about short squeezing. Now, when you're shorting a stock, it's a strategy used by an investor to anticipate that the price of a stock will fall in the short term. And this is essentially just borrowing shares without actually having to buy the shares. So you're betting that the company's stock is going to fall rather than go up. Now, in a short sale, brokerage firms lend out shares of their inventory, and they also lend out their customer shares from margin accounts, or they'll borrow shares from other brokerage firms to lend out to be shorted. So if your shares are used in a short sale and you sell your shares, the brokerage is actually responsible for covering those shares, so it won't affect you at all. So it's not something that you have to worry about. Now, if you're shorting a stock, as the price falls closer to the price you pick, the more money you will make. But as the stock rises, you can essentially lose an infinite amount of money because the stock, in theory, could just keep going up and up and up, and there is no stopping point or designated limit to a stock in theory. Now, to say that a stock like AMC could go to 100,000 per share is pretty crazy because this into perspective, the entire US stock market is about $49 trillion in market cap. If AMC hit 100,000 per share, it would be a larger market cap and more valuable than the entire US stock market. So for that to happen, it's extremely unlikely. And it's also extremely unlikely because only one company on the US stock exchange is actually over $100,000 per share, and that's Berkshire Hathaway, which is Warren Buffett's company, and that's essentially an ETF. Now, back to short selling. Now, if the share price increases soon after you place a short position, you could quickly cover, which means you're buying back the shares and returning them to the broker that you borrowed them from. And if you're lucky, you may not lose very much money. So if you see that a stock is going up rather quickly instead of going down, you could cover your position, buy your shares back, and return them to the brokerage that you borrowed them from to save you some money. Now, or you could hold them and you could wait it out to see if it drops down. When you're borrowing these shares, you're paying a little bit of interest on them per day. So it could get very expensive the longer you hold them. And the higher that it goes, the more and more money you can actually lose. Now, how can you check to see if a stock is shorted? Well, you can look up two things, and it's very simple. You can do this with simple Google check, or you can go on something like MarketBeat, that's what I use, or Yahoo Finance. Two things that you can look at are, it's called a short interest and a short float. A short interest is just the number of shares that have been sold, and it's the number of shares that have been sold short, I should say, but have not yet been covered or closed out. So it's all the pending shares that are shorted but not closed out. And every day this number could change because investors could be closing out their positions or actually adding more short positions. But the simplest stat that you can look at is you can look at the total percentage of shares shorted, or it's called the short float. Now, a float is just the amount of shares that are available to the public. There are a lot of outstanding shares, so a company's outstanding shares may not all be available to the public. So you're going to want to look at the actual short float. This means all of the shares that are available to the average person like you and I. And the short float is the percentage of the total shares available to the public that are shorted. For instance, AMC's short float is around 18% the last time I looked. So this means that 18% of all of the shares available to the public are shorted. So that's rather large. Stock exchanges track and report short interest positions on a monthly basis usually. So you can find short interest information on financial websites, like I said, like Market Beats or Wall Street Journal. Those are two really good sources. Now, what is considered high for a short percentage? Now, opinions on this vary, and you can find a lot of different things on a lot of different websites. But in general, anything above 20% shorting is considered pretty high. So if the short float is above 20%, that typically means something is up and there's probably a good potential for a short squeeze. Now, short floats above 50% means that short sellers would have a very difficult time covering their positions if the price were to rise. This is because the majority of shares have been sold short already. And as a result, short sellers would have to compete with each other to buy the shares back. So let's talk about short squeezes. The reason why GameStop share price exploded this past January is because retail investors saw that the short float was over 100%. So it means over 100% of the shares were shorted. This is incredibly rare and doesn't make sense. How can over 100% of shares be shorted? It doesn't make any sense. Nothing can ever be over 100%. Now, most of the shorts were from hedge funds. So retail investors band together to keep buying shares to force the share price higher. They were able to do this effectively because GameStop only had 50 million shares available. So it's easier to short a stock when there's less shares available. So you can push the price up higher with less people. This caused hedge funds to have to buy the shares back to cover their short positions because as the price kept going up, the more and more money they kept losing. So they were forced to buy the shares at a higher price to stop the bleeding. And this caused the share price to skyrocket because they're buying tens of millions of shares all at once. So people took advantage of the price skyrocketing and they cashed out. Now, GameStop was a little bit different than AMC because over 100% of the shares were shorted in GameStop, where AMC about 20% of the shares are shorted. And also AMC has over 4 times, actually at this point, it's over 10 times the amount of outstanding shares available. So the more shares you have, the more diluted it is. So it's going to be harder to push the share price up. So for AMC to get to GameStop levels where it hit $400 per share, I don't really see that happening. It could probably get to maybe $100 per share, but it's all speculation at this point. It'd be very difficult for AMC to hit $400 per share. So let's talk about some of the risks involved with trying to pull a short squeeze or force a short squeeze. A lot of times it's important to remember that a lot of times companies are shorted for really good reasons. They may be companies that are on the verge of bankruptcy, they have really bad financials, they have bad fundamentals, and maybe they're experiencing a failed product and they're having excessive bad PR. So that's something to consider too. And you could jump in to try to force a short squeeze, and while you're holding your position, waiting, maybe some bad news comes out about the company, and then all of a sudden that share price drops, and now you're going to lose a lot of money. So it's important to do your due diligence and research everything that you're gonna buy to try to force a short squeeze. It's not something that I recommend doing because you're playing with hedge funds and experienced financial institutions. They have more resources than you. They have a lot more, probably have a lot of certified financial advisors that are way more experienced than you, and not you, I mean you and I. So they're going to be able to fight us off for a long time. So you have to be very careful, and it's always something to consider when you're going to do something like this. So there are, advantages to a short squeeze as well, as we saw with GameStop, and we're starting to see with AMC possibly. It's important to remember that when the short squeeze occurs and the price skyrockets, you're not going to want to stay in long. Always take profits. Always take profits. It drives me crazy when I see people online saying never sell, hold forever, to the moon. Well, at some point you have to realize that you made a really good gain and you want to sell and cash in on those profits before it's too late, because when a short squeeze is over, a lot of times that stock can fall fast and hard because a lot of people are going to cash out. So it's something to consider as well. So hopefully this helped clear up short squeezes and what it means to be short on a stock. So thanks for watching. I appreciate the support, and until next time, thank you.